What if I told you that the single biggest bottleneck to the whole artificial intelligence revolution isn't actually a microchip?
Right.
Like, it isn't software, it's not coding, and it's definitely not a lack of data.
Yeah, people always assume it's data.
Exactly. But the ultimate bottleneck for the future of tech is literally a 100-ton piece of heavy spinning metal that, only a handful of old school industrial companies actually even know how to build.
It's wild. It completely flips the script on how we think about this modern tech boom. I mean, we're all so conditioned to just look at Silicon Valley for the future.
Right, the software guys.
Yeah. But right now, the most critical infrastructure for the next generation of computing is actually being manufactured by companies that, well, most people associate with oil rigs and hard hats.
And that paradox, that exact paradox, is why we're here today. So welcome to the special Talk Tickers edition of our deep dive.
Glad to be here.
Today, we are looking under the hood of a company that a really massive portion of the market still just miscategorizes as a traditional oil field services giant.
Oh, absolutely.
We're taking the raw source material. So the Baker Hughes Q1 2026 earnings conference call transcript, and we are cutting right through the dense Wall Street jargon. Our mission is super specific. We want to give you, the retail investor, a really fast, actionable, data-driven breakdown of what is actually happening inside this company, which trades under the ticker symbol BKR.
And, it's a truly fascinating moment to be pulling apart this specific earnings transcript, because the overarching narrative on Wall Street, it tends to be very binary, right?
Yeah. Tech is good, fossil fuels are bad.
Exactly. But the reality hidden inside the actual line items of these transcripts is far more complex. And frankly, it's far more lucrative if you know what you're actually looking at.
Yep. 100%. And we're tailoring this deep dive specifically for you, the investor who's probably looking at your brokerage app right now, just trying to make sense of the market without having to wade through like 80 pages of corporate fluff.
PR statements, yeah.
Right, the synchronized PR statements. So in this deep dive, we're going to deliver the headline numbers to just set a baseline. Then we'll explore the real story behind those numbers, because the raw data never tells the whole truth.
Never.
After that, we'll unpack management's guidance for the rest of 2026. And finally, we'll leave you with a really opinionated bottom line verdict on whether this stock is a buy, a hold, or a sell, based purely on the structural health of the business.
And to do that properly, we really have to look past the top line revenue and dig into the actual mechanics. I mean, when you read through a transcript like this, line by line, you stop seeing just a snapshot the last 3 months.
You see the trend.
Yeah, you start to see these massive structural shifts in the global economy. You see exactly where the capital is flowing today, not just, where it's historically been allocated.
Okay, let's unpack this. I want to start by establishing a really clear baseline here. How did Baker Hughes actually perform against Wall Street's expectations in Q1 2026? Give me the raw data, like the headline numbers that the algorithms trade on the second the press release drops.
Okay, so the headline numbers, at least on the surface, they present a very robust picture of profitability. Let's look at the bottom line first.
Okay.
Adjusted earnings per share, or EPS, came in at 58 cents for the quarter. And that represents a 13% increase year over year. Now, for context, their GAAP EPS came in at 93 cents.
Wait, I want to pause you right there, because for the retail investor listening, seeing two totally different EPS numbers, like one at 58 cents and one almost double that at 93 cents, that can be incredibly confusing.
Oh, yeah, definitely.
Why is there such a massive discrepancy there? And which one should we actually care about?
It's a really vital distinction. So GAAP stands for Generally Accepted Accounting Principles. It's the strict standardized legal framework.
Right.
The GAAP number includes absolutely everything that happened in the quarter. So one-time windfalls, asset sales, massive write-downs, all of it. Adjusted EPS, on the other hand, strips away those noisy one-time items to show you the core recurring profitability of the everyday business operations.
So if they sold off a massive factory for a huge one-time profit, that would inflate the GAAP number to 93 cents?
Exactly.
But the adjusted number at 58 cents tells us what they actually made from just running their normal day-to-day business.
Precisely. And in this case, Baker Hughes had several divestitures. They were selling off non-core parts of their business, which really spiked that GAAP number. But Wall Street, and as an investor, you should primarily care about that adjusted 58 cents.
Because that's the actual engine running.
Right. Because that 13% growth year over year tells you the actual machine of the business is running more efficiently.
Okay, that makes sense. Let's move up the income statement a bit. What does the operational profit look like?
So we look at adjusted EBITDA for that. Earnings before interest, taxes, depreciation, and amortization. This is essentially the purest metric of how much cash the core operations are generating, before the accountants and the tax man get involved.
Got it. What was the number?
Their adjusted EBITDA came in at $1.16 billion. That's up 12% year over year. And crucially, it beat their own internal guidance that they had set for the street.
Wow. Okay. But the number that really caught my eye when we were reviewing the source material wasn't just the sheer volume of billions, it was the efficiency. Their adjusted EBITDA margin.
Yes, the margin hit 17.6%. That is a massive expansion of 140 basis points compared to the exact same quarter last year.
And for anyone who isn't, steeped in bond trader math, 140 basis points simply means 1.4%.
Right.
So in plain language, for every $100 Baker Hughes brings in the door, they are keeping an extra $1.40 in pure operational profit compared to what they were keeping a year ago.
Correct. And look, while 1.4% might sound small in the consumer world, in the world of heavy industrial manufacturing, where you're dealing with billions of dollars in revenue and massive supply chain costs, expanding your margin by 140 basis points is a monumental achievement.
It's huge.
It really signals severe operational discipline.
Okay, I hear you. The EPS looks good, the EBITDA looks good, the margin expansion sounds great. But I am going to push back on you here, and I'm going to do it with a heavy dose of skepticism.
They got me.
Because when I look past those heavily massaged, adjusted profit metrics, and I look at the actual lifeblood of any business, the story changes completely. Free cash flow for the entire quarter came in at just $210 million.
That is a stark contrast, yeah.
It's beyond stark. I mean, for a massive global conglomerate generating billions and billions in top-line revenue, scraping together a mere $210 million in free cash flow feels incredibly light. You can't pay dividends with adjusted EBITDA. You can't buy back stock with an accounting margin. You need cold, hard cash in the bank. So give it to me straight. Are these earnings genuinely strong, or are there clever accounting maneuvers hiding a fundamental weakness in the business? Are they just masking the fact that the money isn't actually showing up?
Your skepticism is exactly what a smart retail investor should be feeling right now. When you see a massive discrepancy between top-line accounting profit and bottom-line bank account cash, alarms should go off.
Right.
But this is exactly why we read the transcripts instead of just the headlines.
Right.
When we dig into the CFO's commentary, the underlying mechanics of that specific cash flow number become very clear. And it actually validates the strength of the business rather than exposing a weakness.
Really? Okay, walk me through the mechanics then. Because to me, an 80% drop in expected cash flow needs a really, really good explanation.
It comes down to two major factors: structural seasonality and geopolitical logistics. Let's tackle seasonality first. The management team was very transparent, and historical data backs this up. In massive industrial businesses, the first quarter, so January through March, is historically and generally their weakest period for free cash flow generation.
Why? Do people just stop buying heavy machinery in January?
Not at all. It's about how performance bonuses and large vendor payments are structured. Think about it. At the end of Q4, in December, companies are aggressively pushing products out the door to hit year-end targets, right? Which depletes their inventory.
Yep.
Then Q1 hits. They have to pay out massive annual employee bonuses for the previous year's performance. They also have to rebuild all that inventory they just sold off.
Which costs money.
Exactly, which means buying huge amounts of raw materials, steel, components, electronics. So in Q1, cash is flooding out the door to pay employees and vendors, while the products they're building won't be sold and turned into cash until Q2 or Q3.
Okay, I understand the calendar dynamics. You pay out your debts in Q1 and you rebuild your stock. But seasonality happens every single year. That alone doesn't explain why this specific Q1 cash flow was so exceptionally light.
And that brings us to the second, much larger factor: delayed customer payments, driven by global logistics. To understand this, we have to look at the massive global headwinds, specifically the ongoing geopolitical disruptions in the Middle East and the effective closure of the Red Sea shipping lanes.
Right, because of the conflict, commercial ships are being targeted.
Exactly. Now, think about the physical reality of what Baker Hughes sells. These aren't, software licenses that get emailed instantly. They are shipping multi-million-dollar, 50-ton pieces of heavy industrial equipment across the planet.
Yeah, massive stuff.
When global transit routes like the Red Sea and the Strait of Hormuz are disrupted, a massive container ship can't just take the shortcut through the Suez Canal. It has to reroute all the way around the southern tip of Africa, the Cape of Good Hope.
Which adds weeks, if not months, to the journey.
Precisely. Now connect that physical delay to the accounting ledger. In heavy industry, contracts are often structured so that the final massive chunk of cash payment is only released upon physical delivery and commissioning of the equipment at the customer site.
Okay, I see where this is going.
Right. So Baker Hughes built the equipment, they incurred all the costs, they put it on a ship in February. In a normal world, that ship arrives in March. Before the end of Q1, the equipment is delivered, the final invoice is triggered, and the cash hits Baker Hughes' bank account before the quarter closes.
But the world isn't normal right now.
Exactly. Because of the conflict, that ship had to sail around Africa. The equipment doesn't arrive until late April or May.
So the revenue gets recognized because the product is technically sold and in transit, which boosts the EBITDA and the EPS, but the physical check hasn't cleared the bank because the physical ship hasn't reached the port.
Exactly. If delivery is delayed, the final invoice is delayed. If the invoice is delayed, the cash collection slips out of Q1 and into Q2. It is purely a timing issue, an artifact of geography and geopolitics.
That makes total sense.
It is not a fundamental lack of demand for their products, and it is not customers defaulting on their debts. The money is coming. It's literally just taking a longer route on the ocean.
That is a phenomenal explanation. And it perfectly illustrates why you can't just look at a screener tool on a website and make an investment decision. You have to understand the actual mechanism of the business.
Always.
So tying this back to the margin expansion, the 140 basis points, they expanded their profitability per unit sold, even while dealing with the massive headache of rerouting their entire global supply chain.
Which is the ultimate proof of strength. Expanding margins while dealing with massive global supply chain chaos and, the associated inflation of shipping costs is undeniably strong. It means Baker Hughes possesses significant pricing power.
They can pass the costs on.
Exactly. They are able to pass those increased logistics costs on to the customer, and their own internal cost-cutting and efficiency measures are actually working.
So they aren't just selling more stuff, they're physically extracting more pure profit out of every single piece of metal they sell, despite the logistical nightmares in the ocean.
That is the exact takeaway from the headline numbers.
Which provides the perfect transition for us. If I'm an investor listening to this, I'm thinking, okay, they have pricing power and expanding margins, but how? How exactly are they managing to pull this off when the global macroeconomic environment feels so incredibly chaotic?
That's a great question.
And to answer that, we really need to dive into the core of this transcript. We need to look at the story behind the numbers, because when you actually look inside Baker Hughes right now, it isn't one cohesive company moving in the exact same direction. It's a tale of two completely different worlds.
It really is. To understand how this company functions today, you kind of have to throw away the old mental model. Baker Hughes is essentially structured as two massive, distinct business segments operating under one corporate umbrella.
Right.
You have the legacy business, OSE, which stands for Oil Field Services and Equipment, and then you have the future-facing business, IET, which stands for Industrial and Energy Technology.
Let's start with the legacy side. In Q1 of 2026, the OSE segment, the traditional oilfield business, was clearly the laggard. The numbers in the transcript show that oilfield services saw revenue drop 9% sequentially, coming in at $3.24 billion. Now, before we go further, clarify sequentially for the listener, because that's a term Wall Street uses a lot that can trick people.
Oh, absolutely. It's an important distinction.
Yeah.
Year over year compares Q1 of this year to Q1 of last year, which adjusts for those seasonal trends we talked about. Sequentially compares Q1 of this year directly to Q4 of last year, the quarter that immediately preceded it.
So a 9% sequential drop means they made 9% less revenue in Q1 than they did just 3 months prior in Q4.
Correct. And while some of that is the normal Q4 to Q1 seasonal drop, the management transcript points the finger directly at geopolitics for exacerbating the decline.
Right. We are back to the Middle East.
Yes. Specifically, the geopolitical conflicts affecting Saudi Arabia, the UAE, and the effective closure of commercial transit through critical choke points.
Mm-hmm.
You have to understand what the OSE segment actually does. We aren't just talking about drill bits here.
What are they building?
Baker Hughes provides incredibly complex, massive infrastructure for oil extraction. Things like subsea trees.
Okay, let's Eli 5 that. Explain it like I'm 5. What is a subsea tree? Because it sounds like something you'd find in a kelp forest.
It's a great term, but it's purely mechanical. Imagine an oil well drilled deep into the ocean floor. You can't just leave an open pipe down there. The pressure would blow it out.
Obviously.
A subsea tree is a massive, multi-ton assembly of specialized steel valves, spools, and fittings that is installed directly on top of the wellhead on the ocean floor. It acts like a giant, highly complex faucet that controls the flow of oil or gas out of the well. It allows engineers to inject chemicals to keep the well flowing, and it serves as the ultimate safety valve to prevent blowouts.
And these things are massive, right? Like they weigh tens of thousands of pounds.
Exactly. They are custom engineered, incredibly heavy, and incredibly expensive. Now, the Middle East is obviously a massive market for this kind of well construction and extraction technology. But when the shipping lanes freeze or become prohibitively dangerous and uninsurable for commercial transit, a company like Baker Hughes can't just load a 50-ton subsea tree onto an airplane.
The logistics just completely break down.
Completely. That revenue effectively hits a brick wall until the logistics can be rerouted, which takes months, or until the conflict subsides.
Yeah.
You can't deliver the equipment, so you can't record the revenue.
And the CEO, Lorenzo Simonelli, was very blunt about this in the transcript. He noted that the Middle East revenue specifically might fall by more than 20% sequentially heading into the next quarter.
Yeah, that's a big hit.
A 20% drop in one of your core regions is a massive structural hit to the traditional side of their business.
It is a severe headwind. And honestly, if Baker Hughes were still just a pure play, traditional oilfield services company like they were a decade ago, this earnings call would have been an absolute disaster. The stock would be getting crushed by the market right now because their core delivery mechanism to their biggest market is compromised.
But they aren't getting crushed. And this is exactly why we opened this deep dive the way we did. This is the mispricing paradox. Because while the traditional oil field side was taking an absolute beating from geopolitics and supply chain chaos, the other side of the house, the industrial and energy technologist segment, or IE, was experiencing something entirely different. The IE segment didn't just have a good quarter, they had an absolute monster of a quarter.
The numbers in the IET segment are staggering. They pulled in record orders of $4.9 billion. Just let that sink in.
Wow.
That is the third consecutive quarter that this specific segment has booked over $4 billion in new orders. Their EBITDA for IE rocketed 35% year over year to hit $678 million.
And the margin?
The margins for IET crossed the 20% threshold.
Which is huge.
It is a major milestone. Crossing a 20% operational margin in heavy industrial technology is incredibly rare. It proves to the market that the products Baker Hughes is manufacturing in this segment are highly differentiated. They aren't selling commodities.
People aren't just shopping around for the cheapest one.
Exactly. Customers aren't price shopping between 3 different vendors. Customers are paying an absolute premium because they desperately need the specific technology that Baker Hughes is manufacturing.
And this brings us to the absolute core thesis for the retail investor right now. What exactly are they manufacturing that is commanding a 20% margin and $5 billion in quarterly orders? When we talk about the artificial intelligence boom, the AI gold rush, everyone knows the usual suspects.
Right, the chip makers.
Yeah, you hear about NVIDIA making the chips, you hear about Microsoft and Google building the large language models, you hear about the software, the algorithms, the data, but nobody talks about the physics of it all.
Because the physics aren't as glamorous as the software, but they are the immutable law governing the entire industry.
Exactly. I want to use a systemic metaphor here to really explain what is happening, because the old cliche of selling pickaxes during a gold rush just doesn't capture the severity of the bottleneck. Think of the public electrical grid in the United States or anywhere in the world like a city's public water pipeline system. It's old, the pipes are narrow, and it was engineered 50 years ago for a very specific, predictable amount of flow. Every house gets a trickle and it works fine.
Right.
Now along comes the AI revolution. Building a massive gigawatt-scale AI data center and trying to plug it into the public power grid is like taking a high-pressure industrial fire hose and trying to connect it to a rusty garden tap on the side of your house.
Oh, this is just not going to work.
The pressure demand is so instantaneous and so massive that the underlying pipes, the public grid, will literally burst. Or in the case of electricity, the grid will melt down, causing massive blackouts. Tech companies simply cannot rely on the public grid to power the future of AI. It is physically impossible.
The sheer amount of compute power required to train these AI models is straining municipal power grids to the breaking point. A single query to an AI model uses exponentially more electricity than a standard Google search. When you multiply that by billions of queries and millions of specialized microchips running constantly, the thermal and electrical demands are astronomical.
And that's where Baker Hughes comes in. They aren't building the data centers. They are building the massive private water towers right next to the house, so the data center never has to touch the public pipes. Let's look at the specific data points from the transcript. Out of that $4.9 billion in IET orders, a staggering $1.4 billion were strictly in power systems.
And the specific customers they are landing are fascinating. We're talking about a massive 1 gigawatt order for a North American data center project. They secured another order to deliver 1.21 gigawatts of generator capacity for boom supersonic data centers.
Pause on that number, 1 gigawatt. For the listener trying to visualize this, how much power is 1 gigawatt?
To put it in perspective, 1 single gigawatt of electricity is roughly enough power to continuously run a medium-sized city of about 750,000 homes.
That's insane!
And Baker Hughes just received an order to provide that exact amount of power generation capacity for a single localized data center project. That is the scale of the energy demand we're talking about.
It's mind-boggling.
Yeah.
And to facilitate this, the transcript heavily references a concept that I want you to break down for us. Behind the meter power generation. What does that actually mean mechanically?
Behind the meter is the critical concept for investors to understand this shift. When you plug something into your wall at home, you are in front of the meter. You are pulling power from the public utility grid, and the utility meter tracks what you use. Behind the meter means a company like a major tech giant building an AI data center is completely bypassing the public utility grid.
They're going off grid.
Right. They're not waiting 10 years for the local government to upgrade the transmission lines. Instead, they're building their own private self-contained power plants physically located right next to their data centers.
They are becoming their own utility companies.
Exactly. And to generate that much power, that reliably, without relying on the grid, they are buying specific pieces of heavy machinery from Baker Hughes. They are buying what are called aeroderivative gas turbines.
Okay, let's ELI5 that as well.
Right.
What is an aeroderivative gas turbine? Because aeroderivative implies airplanes.
That's exactly what it is.
Yeah.
At its core, an aeroderivative gas turbine is literally a highly advanced jet engine, very similar to the ones you see on a Boeing 777. But instead of being attached to the wing of an airplane to generate thrust, it is bolted to the ground inside a power plant.
Wow.
Instead of pushing air out the back to fly, that rotational energy is used to spin a massive electrical generator.
But wait, why use a jet engine? Why not just use massive solar panel farms or wind turbines to power these data centers? I mean, the tech companies all talk about being green and carbon neutral.
It comes down to the concept of baseload power versus intermittent power.
Huh.
Solar and wind are intermittent. The sun goes down, the wind stops blowing, and the power generation drops to zero.
Yeah.
You cannot run $1 billion AI data center on intermittent power. If the servers lose power for even a fraction of a second, you lose millions of dollars in compute time and potentially corrupt massive AI training models.
So they need guaranteed 2047 power that never blinks.
Exactly. Baseload power. Aeroderivative turbines are incredibly reliable. Furthermore, unlike massive coal or nuclear plants that take days to start up or shut down, a jet engine can spool up to maximum power in a matter of minutes. It provides the exact, high-density, highly responsive power profile that a massive data center requires to smooth out its energy demands.
And Baker Hughes manufactures a very specific model of this turbine called the Nova LT. And this brings us to what might be the single most important sentence in the entire 20-page earnings transcript. The management team explicitly stated that Baker Hughes is completely sold out of their Nova LT gas turbines through the year 2028.
Sold out for the next 2 to 3 years.
That is an incredible data point for an investor. They're essentially communicating to Wall Street, we have maxed out our physical manufacturing capacity. We literally cannot build these massive turbines fast enough to meet the demand coming from the tech sector.
And the runway for this demand is staggering. In the call, the CEO referenced external projections indicating that global power demand is expected to double by the year 2040, driven almost entirely by data centers, AI compute demands, and the broader electrification of the economy. Baker Hughes is positioned at the absolute nexus of this growth.
But it isn't just the physical heavy metal hardware. And this is where the margin expansion really starts to make sense. The transcript also announced a new AI power optimization collaboration directly with Google Cloud. How does software tie into spinning jet engines?
This is where the hardware meets the software, where the business model transitions from a one-time hardware sale into a highly lucrative recurring revenue stream. Baker Hughes has developed a digital asset health and predictive maintenance software platform called Cordant.
Explain predictive maintenance. How does software optimize a physical turbine?
Think about the physical stress on a jet engine spinning at tens of thousands of revolutions per minute, 24 hours a day, 365 days a year. The traditional way to maintain it is schedule-based. So every 6 months, you shut the whole thing down, take it apart, replace parts whether they are broken or not, and put it back together.
Which takes time.
Yeah, and that causes massive, costly downtime for the data center.
It's like changing your car's oil every 3,000 miles, even if the oil's perfectly fine.
Exactly. Predictive maintenance uses thousands of microscopic sensors embedded in the turbine that constantly feed data into an AI model like the ones developed with Google Cloud. The software monitors microscopic vibrations, thermal fluctuations, and pressure changes in real time. It can detect anomalies weeks before a human operator would notice anything.
So the AI can essentially say, hey, blade number 47 is vibrating 0.1% faster than normal, which indicates a bearing is going to fail in 14 days. You need to schedule a targeted repair next Tuesday at 2 a.m. when data center traffic is lowest.
Exactly. It prevents catastrophic, unplanned failures and optimizes the fuel efficiency of the turbine. And the financial takeaway from the transcript is this. Orders for Cordant software related to power systems doubled year over year.
Wow.
So Baker Hughes isn't just selling a $20 million piece of hardware once. They are selling the hardware, and then they are selling a multi-year, high-margin software subscription to optimize that hardware. It is a recurring revenue model layered directly on top of heavy industry.
And that is exactly how you push industrial margins past 20%. You blend the hardware with the software.
Okay, so we've established the reality of Q1. The traditional oil field side is getting bogged down by geopolitics in the Middle East, but the industrial and energy technology side is riding an absolute rocket ship of AI-driven demand, selling out of their most important products for years.
Right.
Which naturally brings us to the next critical phase of our deep dive, management guidance. This is where we connect the reality of this massive Q1 beat to what the corporate leadership actually expects to happen for the rest of 2026. Because honestly, reading this section of the transcript gives you a bit of whiplash.
It does. It requires a lot of reading between the lines to understand the corporate psychology at play here.
Right. Because on one hand, IET is booming. They are sold out of turbines, software orders doubled, margins are expanding. If I'm an investor, I'm expecting management to be popping champagne on the call, aggressively raising their full-year financial targets and telling Wall Street to buckle up. But when they actually gave their official guidance for the rest of the year, management sounded surprisingly pessimistic, or at the very least heavily cautious. Why?
Let's look closely at the exact numbers they provided to the analyst. For the immediate next quarter, Q2, they guided for things to be relatively flat. They expect total revenue to come in around $6.5 billion and EBITDA to sit at roughly $1.13 billion. That is solid, but not explosive growth.
And for the full year 2026?
For the full year, they maintained their previously established revenue and EBITDA ranges. They didn't raise them. But crucially, the CFO explicitly stated to the analyst that they expect to come in, and I quote, slightly below the midpoint of those ranges.
Slightly below the midpoint. That is Wall Street code for lower your expectations.
Exactly. They added a specific caveat. They expect the IET segment, the tech and power side, to easily hit at least its $2.7 billion EBITDA midpoint. So the tech side is safe and growing as expected. But they heavily signaled that the traditional oil field side, OFSE, is going to struggle to hit its previously stated targets.
Okay, I have to press you on this. This is where the retail investor gets confused by corporate speak. Why is management voluntarily softening their full-year outlook if they are literally sold out of their hottest, most profitable product for the next 2 years?
I know, it sounds weird.
If you have guaranteed buyers for every single turbine you can physically build and your margins are expanding, why walk back the overall company guidance? It feels contradictory.
It feels contradictory until you understand the geopolitical assumptions that the CFO has to hard bake into their financial models. Management is actively choosing to be conservative, and they are doing it to protect themselves. In the transcript, the CFO explicitly laid out their baseline assumptions.
Which were?
Their financial guidance assumes that the Middle East conflict will persist at its current level of intensity through at least the end of June, without major escalation, but keeping those key shipping lanes effectively closed or severely restricted.
So they are mathematically modeling for a bad scenario to continue indefinitely.
Exactly. They are pricing in the absolute worst of the logistics bottlenecks. Think about the psychology of Wall Street guidance. The absolute worst thing a management team can do is overpromise and underdeliver. Wall Street will punish your stock price severely if you miss your own targets.
So if you were the CEO and you know your oil field business is heavily reliant on moving massive equipment through the Red Sea and you have zero control over the geopolitical conflict happening there, you have to assume the worst.
Precisely. If a massive shipping container full of drill bits and subsea trees physically cannot get through the Strait of Hormuz safely, the equipment sits on a dock or it takes a 2-month detour. Either way, Baker Hughes cannot legally recognize that revenue in the current quarter. Management is communicating to Wall Street. We are putting an artificial ceiling on our expectations for the traditional oil field side of the business until the geopolitical dust completely settles. Don't expect heroics from OFSE.
I want to make sure the listener truly understands the nuance here, because this is the crux of the investment thesis. It's the difference between a demand problem and a supply chain problem.
It is the most critical distinction in corporate finance. A demand problem means your products are obsolete. It means your competitors are building better turbines, or national oil companies have simply stopped drilling for oil. If you have a demand problem, your business is fundamentally broken and your stock deserves to drop.
But Baker Hughes does not have a demand problem.
Not at all. They have a supply chain problem caused entirely by external geopolitics. The demand is still there. The oil is still in the ground in Saudi Arabia and the UAE. The national oil companies still desperately need the extraction equipment. Baker Hughes has the signed contracts. The only issue is the physical inability to deliver the supply on a predictable timeline.
And a supply chain problem is temporary. Geopolitics shift. Shipping lanes eventually secure or logistics routes adapt. The equipment will eventually be delivered, and that revenue is simply deferred to a future quarter, not lost forever.
Exactly. The value hasn't evaporated. It has just been shifted to the right on the calendar.
And that realization that the temporary drag on the traditional side of the business is masking the massive structural boom on the technology side leads us perfectly into the final phase of our deep dive. We've looked at the headline numbers and the cash flow mechanics. We've unpacked the massive AI power generation story and the physics of data centers. And we've analyzed the highly conservative, geopolitically defensive management guidance.
Yep, we've covered a lot.
Now, we need to bring all of this complex analysis together for the ultimate talk ticker's payoff. We need an actionable verdict for you, the retail investor listening right now. What do you actually do with this information?
To make a definitive, actionable verdict, we have to look past the noise of the current quarter's shipping delays and look at the structural financial health of the company going forward. And in this transcript, there are 3 very specific, undeniable data points that paint a crystal clear picture of Baker Hughes's future.
Let's hit them one by one. The first is the RPO. For the listener, RPO is Wall Street jargon that stands for remaining performance obligations. In plain English, what is RPO and why does it matter?
Think of RPO as the ultimate legally binding backlog. This isn't just a list of interested customers or a pipeline of potential sales. RPO represents ironclad contracts that have been signed, sealed, and delivered. It is money that customers have legally committed to paying Baker Hughes for future deliveries of equipment and services.
And what is the RPO number sitting at right now?
According to the Q1 transcript, their RPO is sitting at a record $33.1 billion.
$33.1 billion in guaranteed future revenue.
Exactly. That is a massive, impenetrable financial cushion. That is revenue that is already locked in, just waiting to be executed and recognized over the next few quarters and years. It provides a level of forward visibility and stability that most companies can only dream of. Even if the global economy enters a recession tomorrow, Baker Hughes still has $33 billion worth of work to do.
Okay, that's data point 1, a massive backlog. What is the second data point?
The second point is the IET book-to-bill ratio, which came in at 1.5x for the quarter.
Break down the math of book-to-bill for anyone new to the term.
It's a simple ratio that measures supply and demand momentum. The bill is the revenue you actually recorded and billed to customers in the current quarter. The book is the value of the new orders you signed in that same quarter. A ratio of 1.0 means you are replacing your revenue exactly as fast as you earn it. You are treading water.
But Baker Hughes is at 1.5x in their IET segment.
Right. Which means for every $1 of revenue they actually recorded and shipped out the door in Q1, they signed new, binding contracts for $1.50 in future business. They're taking in new business 50% faster than their massive global manufacturing footprint can currently ship it out.
Which perfectly aligns with the fact that they are completely sold out of their Nova LT turbines until 2028. The global demand for AI power infrastructure is vastly outpacing their historical manufacturing capacity.
And management isn't just sitting on their hands. The transcript notes that because of this 1.5x book-to-bill ratio, they are actively spending capital to expand their facilities. They just inaugurated a massive new aftermarket and manufacturing site in Italy, specifically to try and keep up with the demand for turbine production and servicing.
Okay, we have a $33 billion backlog, and we have a 1.5x order momentum in the tech segment. What is the third data point for the structural bottom line?
Divestitures and balance sheet cleanup. Over the past year, management has been actively trimming the fat. They are selling off non-core, lower-margin businesses that don't fit the future vision of the company.
Right. The transcript mentioned a few specific ones. They sold Waygate Technologies, a business called PSI, and they formed a new joint venture with a company called Cactus to offload some wellhead operations.
Yes. And the financial result of those moves is critical. Those divestitures are expected to generate roughly $3 billion in gross cash proceeds just this year.
That's a massive influx of liquidity. What are they doing with that $3 billion?
It goes straight towards strengthening what is already a fortress-like balance sheet. They're using it to reduce debt, which lowers their interest expenses and expands margins further. They're using it for strategic tuck-in acquisitions to bolster their software and AI capabilities.
And for the shareholders.
Most importantly, for the retail investor, they are using it to return capital to shareholders through dividends and stock buybacks. They are making the entire corporation leaner, more financially bulletproof, and hyper-focused on its core mission of next-generation energy infrastructure.
Okay, we have analyzed the mechanics. We have laid out the data points. I'm going to push you for a definitive, highly opinionated stance right now. Give it to me straight. For the retail investor who's currently holding BKR stock in their portfolio, or the investor who is looking at their screen right now considering hitting the buy button based purely on the structural realities revealed in this Q1 2026 transcript, are we bullish or bearish?
This raises an important question, and frankly, it is perhaps the single most important conceptual question for anyone looking at this specific ticker symbol today. Are you buying a traditional legacy oilfield services company that is subject to the boom and bust cycles of crude oil prices? Or are you buying a high-tech, highly specialized energy infrastructure company that is supplying the foundational physics for the global artificial intelligence boom?
And what is your answer to that question?
The verdict is decidedly, unapologetically bullish.
Unpack that verdict. Defend it. Why are you so bullish when the overall corporate management just explicitly guided expectations downward for the rest of the year?
Because you have to look past the temporary noise to see the structural reality.
Yeah.
I am bullish because of that massive $33.1 billion backlog. I am bullish because of the 1.5x book-to-bill ratio in the technology segment. That combination provides an incredibly thick, multi-year safety net for the business.
But what about the OSE side? What about the Middle East geopolitical drag?
The geopolitical drag on the oil field side is undeniably real in the short term, but that drag is precisely what makes this stock attractive right now. That temporary logistical headache is artificially holding down the overall valuation and PE ratio of the entire stock. Market algorithms see a drop in Middle East revenue, and they compress the multiple.
So the market is effectively penalizing the booming AI power infrastructure business because the legacy oil drill bit business is stuck on a ship going around Africa.
Exactly. It is a classic mispricing paradox. For current holders of the stock, this is a very strong hold. Do not get shaken out by a quarter of light cash flow caused by shipping delays. The macro transition from purely extracting fossil fuels to managing the broader high-tech energy spectrum is happening, and Baker Hughes is successfully capturing the most lucrative value in that transition.
And for prospective buyers, like the people with cash on the sidelines.
For prospective buyers, that temporary weakness in the Middle East oil field segment is actually providing a fantastic, potentially rare entry point. Because of the way the company is currently categorized by the broader market, you are getting a massive discount on what has effectively become a backdoor play on the AI data center power boom.
That is the phrase right there, a backdoor AI play.
It truly is. You are buying the company that is selling the critical physical infrastructure required to make the entire AI revolution physically possible. But because they still have oil fields in their historical DNA, the broader market is still pricing the stock, at least partially, as if it's just a cyclical drilling company. The market hasn't fully digested the fact that they are a 20% margin technology infrastructure provider with a multi-year wait list for their products.
That is exactly the kind of actionable, structural insight we aim for here on Talk Tickers. It's about looking past the immediate headline guidance and the short-term cash flow blips to see the underlying physical reality of the order book. Baker Hughes is in the middle of a massive evolutionary transition. They are moving from a company that simply extracts molecules from the ground to a company that generates and optimizes the electrons that power the digital future. And the technology world is buying absolutely everything they can physically build.
And crucially, they are managing that massive transition while actually expanding their profit margins, generating billions in divestiture cash, and maintaining a fortress-like balance sheet. It is a highly compelling setup for the long-term investor who understands the mechanics of the business.
Which brings us to the end of this incredibly detailed deep dive. Our mission today was to take the dense, jargon-filled, heavily caveat-laden Q1 2026 earnings call of Baker Hughes and distill it down to the essential data-driven facts and the structural truths that matter to you, the retail investor. We've seen a company navigating severe, unavoidable geopolitical turbulence in its traditional legacy markets, while simultaneously riding an absolute rocket ship of hyperdemand in the AI power generation sector.
It truly is a profound corporate transition to witness in real time. By blending massive heavy industry with predictive AI software, they are actively redefining what it means to be an energy company in the 21st century.
Thank you for taking this deep dive with us into BKR's earnings. But before we go, before you close your brokerage app or move on with your day, I want to leave you with a final lingering thought experiment to mull over.
Okay.
We talked about the CEO noting that global power demand is expected to double by the year 2040. We know the sheer mind-bending scale of the gigawatt data centers being planned by the tech giants. And we know, as a verified fact from this transcript, that industrial manufacturing giants like Baker Hughes are already completely 100% sold out of their premium power generation hardware, those massive spinning Nova LT gas turbines, until the year 2028.
The physical manufacturing capacity of the heavy industrial sector is simply maxed out. You cannot just spin up a new jet engine factory overnight.
So if that is the fundamental reality of the physical world, think deeply about this. Will the ultimate bottleneck for the future of artificial intelligence not be the cutting-edge microchips from Silicon Valley? Will it not be the coding or the software algorithms or the size of the large language models?
Good question.
Will the true bottleneck to human technological progress simply be the sheer physical availability of heavy spinning metal turbines? And if the trillion-dollar tech giants literally cannot turn on their AI data centers without these highly specialized physical machines, who really holds the ultimate leverage in the tech world of tomorrow? The guy writing the code or the guy building the engine? You thought you were looking at a familiar, old-school muscle car, but the high-pressure fusion reactor hidden under the hood might just turn out to be the most important engine in the global economy. Keep a very close eye on the physical power. We will see you on the next deep dive.